so much focus has been so far on the inflation outlook and really what happens with the Treasury curve and if we're looking at a potential misstep by the biggest central bank in the world. How do these geopolitical implications weigh into that now?
I think the assumption is still the Fed would still move in March. Inflation has been a much more of a domestic concern. So I think the Russia-Ukraine situation certainly bear watching to see if there's any scope for escalation or de-escalation from here onward. The market will be, assessing that and what kind of impact to energy prices and on broader economic impact, particularly for Europe. So from Asia, where we stand, it is a more of a beta move that we need to be watching from reaction of credit markets around the world and also in the equity market.
Do you see much contagion when it comes to EM debt?
The Russia portion probably already has reacted to some extent overnight. I think Asia, particularly on the credit side, we are experiencing, particularly for the high yield segment, more of an idiosyncratic nature since last year. More of that led by the China property segment. So it might have a little less influence from this EM risk on, risk off type of move, but more reliant upon what China might do in terms of their easing policy and how they might target economic growth for 2022. Now, that said, we are anticipating some issuance of sovereign debt by Asia countries, possibly this week or next week, and hence that might be driven more by the EM investor demand, and that would have some implication from the Russia situation.
In terms of the China property market, we had another property developer who looked like it was in pretty good shape. Genro suddenly not in good shape. Is that a red flag, or is that just sort of the tail end of what's going on there?
I think what you're referring to is their kind of promise or their calling of a perpetual in January, and now they need to seek consent solicitation to not call that. In general, I think the property market has been quite weak, particularly for end user demand, and some numbers are coming through from some of the December and January sales number. The liquidity situation from many of the developers has been very tight since Q3, Q4 of last year, and there is a maturity wall coming up, over the course of the next 2 or 3 quarters. What we are seeing, though, is the market is already pricing in for that weakness to continue. There's considerable kind of discount or stress in the market. So we'll be watching for any policy changes around that. We believe China will value stability quite highly this year. With the joint sessions in March, they would likely reiterate a growth target around 5% area, and housing will need to be a very critical part of that to continue the stability mantra. And we are watching already a number of easier or fine-tuning measure on the property segment. We have noticed that in selective cities, there has been lowering of mortgage rate, lowering of down payments, and there are other relaxation that might be coming through on certain escrow account usage of pre-sales. So those are all indicators that might be slightly more positive, but it might take time to take effect.
So much focus on China, so much focus on Fed rate hikes. Now we got focus on Ukraine. Meanwhile, you and your team are pretty positive on India and Indonesia. Are they sort of almost in their own world to a certain extent, where there gives them another reason to be worth looking at?
I think both of these countries we would expect economic growth to be in pretty decent shape this year. They don't have some of the kind of policy changes, regulatory crackdowns that we are noticing in China since last year. So it is almost a safer, more defensive area to be. particularly for Indonesia, we see the country having kind of established themselves and could be re-rated as they have that economic growth with pretty benign inflation. If you look at the currency market and their rate market, it has achieved quite a stable behavior despite all the noise around the world right now.
Do you still keep Chinese sovereigns in your portfolio as a diversifying element? Because I know you've sort of called on the divergence play between China and the US, given the drip feed of easing measures that we've seen.
Well, we have been very positive on China onshore kind of interest rate market, and they have outperformed. So we are taking some chips off the table at the moment. They had a window before the Fed tightening to ease, and we have seen some rate cuts along the way. So we are looking at this now as more of a fair value rather than being cheap. And in terms of the overall dynamic, as some of the easing measures come through, maybe the economic growth will also kind of respond to it. The easing measure might also entail more of a credit growth than necessarily more monetary or rate cutting coming in terms of that action. So the interest rate market may have less room to go down from here.